Hey everyone, welcome back to another video. In this video, we'll be talking about portfolio rebalancing. But before starting further, I would like to ask you one thing. Is that have you ever seen or get notified in your investment app that hey, it's time to uh, adjust, rebalance your portfolio, or in the news we see that the XYZ index fund is being rebalanced. So, what is the basic meaning of rebalancing and why it is a really important factor in the finance world? So, if I talk about what is portfolio rebalancing, it is the way you adjust your asset classes into different allocations. So, for example, if I have four stocks, for example, Apple, Amazon, Microsoft, or Google. So, for these four stocks, I would have a asset class. For example, for Amazon, I would give like 0.25. For Apple, for Google, it may be, I give like zero point 0.2, or it's like 20% or 25%, like that. So why it is important to, try to have a rebalance or to, have a asset weights. The reason is the market always moves. The market is volatile and it changes every single time. And due to this, you are very much exposing yourself to risk in the industry. And due to this, it may happen you lose your money in the long run. Second is why we should actually do portfolio rebalancing is because of portfolio optimization. It improves your returns in the long term by buying systematically, buying low and selling high. So this is something that you have actually learned, and it's something, buying low and selling high is something which is being taught a lot of time, and this actually applies in the portfolio rebalancing as well. The second is when you are the third or the very main reason to follow portfolio rebalancing is that you are not emotionally attached to any stock. And this is something which really happens. It has also happened with me. Is that if a stock has given me a really good return, for example, a multi-bagger return, which has never happened, but if it does, so I'm very confused whether I should keep it or not, or I should sell it. So it's like a FOMO that I have now, and I emotionally attached to the stock. This, so when you follow portfolio rebalancing, you're not emotionally attached to any stock. For you, it's just a stock. And this is something that we'll be talking in this video today. And for this, we'll be taking two data or the asset classes. One is SPY, which is the S&P 500 equity market, and TLT, which is an ETF, or which is an ETF. So in generally, if I talk about the asset allocation, generally in the finance world, the asset allocation is 60 to 40%. The 60 goes to the equities and 40 goes to the ETF. Over here, we could see that during the long run, from like 2019, if you made this, when we actually made this asset allocation, we could see that it was a really good, we had $100,000 in our portfolio, and $60 went to the equities and 40 went to the um the TLT. And here's the percentage: 60 to 40% is being followed. But as we go as we go further in the future, in 2025, we see that uh, the the percentage of allocation in SPY has been increased to 82%, and the TLT is only 18%. So we see that in the long run, if we don't follow the rebalancing portfolio, the strategy, it can lead to this um, a fluctuation or a difference in our asset classes. And you may be thinking that who cares, since we have such a nice return in our portfolio. We have about $188,000, but in reality it is not following the orders or the strategy that we wanted to implement in the first case. And we need to remember this thing that most of the time, when you are a beginner or when you are following these rebalancing strategies, we try to look at the return, not the factors involved. So why the reason that we actually do portfolio rebalancing, why it is so much pushed by the portfolio managers, is to firstly portfolio diversification. Since this 60 to 40% is a really good portfolio diversification, it is exposed to the risk as well. It is the way you are exposed to the risk, but in not a very high, it's not very risky. At the same time, it can also generate you returns. But over here, for example, if I give you an example, for example, it was not SPY, it was, Tesla or any other stock that you may imagine. And if that stock got, is there any crash or there's a management problem or there's a competitor doing really good, it can lead to a really bad effect on your portfolio in general, because the portfolio allocation for this stock is higher than the other stocks that you have taken. And this is something we need to remember, that it is really important to do portfolio managing, because it mitigates or it minimizes your risk as well. And in we can also see in the graph, like the blue one represents the SPY and the allocation is the TLT, and shows that in the long term we can see that the SPY is more than 75% and the TLT is, not even 20%. This is something that we covered up here as well. And we need to remember this, not to see the returns, but our strategy or the basis or the principles that we were following. Now, by this, I would like to, show you the code for this and how we could make one. And before starting, I would, tell you that this code will be uploaded on the GitHub, that you'll find the link down in the description. So if you want to download it, you could. And first thing we have to do, the step one is to import the required libraries. So I imported Finance to, for downloading the historical data, pandas, numpy for manipulations, and matplot library for, plotting the graphs, and it goes on and on. And then we go to step two, which is defining the period and the ticker list. So the ticker list is SPY and the TLT, and the start date is 2029, 1st January, and the end date is for today, right now. So it gives you the latest return. Now, before starting what are SPY and TLT, you can just have a look here. The SPY is an ETF tracking, the S&P 500, representing the US largest equities with a high growth and a high risk. And TLT is a long-term US Treasury bond, which is very stable and, you know, has lower returns and risk. So together, it's like a stock and bond mix that we are actually doing. So if we, you know, do this, and this is, it's working very fine, and this is also working fine. And then we, step three is to download the data using the Finance, and we are able to download the data. And over here, we could check even that 2029 was January 2nd, there's a $226.28, and for the TLT it is $102.41, and so on it goes. Over here now, it's a really important thing, since we have now tried to describe the code, like the initial capital of our is like $100, and the initial weight is 0.6 and 0.4, which is like 60 to 40%, which I told you in before. And why we actually do this. So uh, what will happen if we, have no rebalancing uh, in the portfolio and we just left it like this? So in this case, first thing what happened is that the weight drift will be related to the asset performance. So what will happen is the one which has, moved a lot, which has grown a lot, will have a higher asset allocation than the one you wanted, than the one which didn't, grow to this potential. And due to this, there will be a mismatch in your asset allocation in whole, which could lead to, a really higher risk exposure of risk in the future. And if we try to show it the portfolio, we could see, that on 2029 the portfolio is six figures, 60 to 40, but then it came to 59 and 40% due to there was a change, and this goes so and on in the long term. Also, here is also the weight, like 83. This is the S&P 500 weight, and the TLT weight, which is like 83% and 16%, and this goes on and on, which is happening in the current time, which is 2025. We could able to see. So now when we plot the graph, we are able to see that if I, in general, we started from 109K and we reached about 200K approximately. And if we see that in the long term, it is something, we have gotten a return, but was it related to the strategy? What is related to the principles that we actually wanted it to be? Like over here, we could see that the blue line represents the SPY and the orange line represents the TLT. So uh in the beginning of 2029, we could see that there was a really good allocation between um both the asset. Like it was 60 to 40% was being followed. But when we moved it, when we actually wait, oh my God. Okay. But when we went to the 2025, we are able to see that the SPY had a higher allocation than the TLT. And over here, it has reached about 81%, and right now it is at 82%. So this is leading to a really, fluctuation in our portfolio in general, and it is very bad since we are getting return, but at the same time, we are not following the rules that we wanted, or the foundation we wanted it to be. And if I go to the next slide, so what we're gonna do now is we would try to, plot a bar graph to visualize the weight in each and every year. So over here, you could see in 2029, there was a bit of increase in the SPY weight than the TLT. And in 2020, it remained the same, but 2021, it just grown, and the TLT, since it just got to smaller and smaller by the time we reach 2025. So to try to not to be in this stage, what is the reason, or what are the precautions that we could take? So for this, rebalancing could be done in either a month or a quarter or a year. It really completely depends on how you wanted it to be. So if we take, for example, today is 5 August 2025. So today I do a rebalancing of my portfolio. So today I do the rebalance. The next year I'll be, trying to do the rebalancing again. So it would be 5 August 2026. And every year, the end date, the start date when I rebalance, and the end date would be the time when I would again see my portfolio and we try to adjust the asset allocation as per the ratio that I allotted to them. So for this, we'll be setting up a rebalancing frequency. Now, the steps include, we try to create a data frame called as the returns, and then we use the data returns to find the last trading day for each of the rebalancing period, like each year and quarter, which I told you earlier as well. Now, what this does actually is that it, grabs the latest available trading data in each and every period. It resamples the return index based on your chosen frequency. For example, if in this video we'll be going yearly, and these are the dates when we'll try to reset the portfolio weight to the target allocations. And if we see over here, the asset allocation is as for 2029 December, 31st December, and then 2020 we do the rebalancing again, which is 31st December 2020, and this goes so and on for each and every year. So like 2021, 2022, it's the same 31st December 2022, and 2025 30% or like this. Now we will, try to create a bar graph, and I will try to show you what will happen if we, try to create a rebalanced portfolio. So if we make this, oh wait, um, it's not working. Uh, hmm, okay, just a minute. Yeah, it's working. So over here, we could see that the S we over here as well. If we, if I try to tell you that we started from 100K and we reached the approximate, return. And over here, we could say we have got, about $180, which is a really good amount. And but if we try to see this part, okay, so over here we could see that the SP500 and the TLT allocation is being followed very greatly. Oh my God. Um, oof. Oh, okay, yes. It's the home one. I forgot. So over here we could see that in some of the cases there is a, a a asset allocation is not being followed. For example, over here. So if I try to zoom in, just a minute. Okay, yes. So here we could see that in the February, if we go, so the asset allocation here is 61 and the over here is 38. But over and for this, it is each and every month. So over here, after 1 month, it again went to 58, again went to 41, which is, it's very not precise, but it's approximate value. And this is being followed for each and every scenario of the case. And over here we could see, oh, this is the wrong one. Okay, this is the right one. So over here we could see that for the January 2020, when it was 67% for the SPY, and TLT it was 32%. But after, we reached, February, it again came to the, the normal part, which was 58% for the SPY, which is approximately about 60%, 41%, which goes to the uh, TLT in general. So in reality, if we see that we are following the rules, we are following the asset allocation or the rebalance portfolio, which we meant it to be. So for this, we got our returns. It may, I will tell you the difference, whether we got more returns in the than the without rebalance one or the rebalance one. But over here, we are able to see that the asset allocation on the weights we gave to the different classes are being followed. So we are following the principles and the focus. Now, it's a very interesting thing. So when you come to the over here, you could see that the portfolio allocation is being told that 59%, 40% was for 2029 first January, 1st January, and for March. But this goes on and on. And over here, you could see the asset allocations for 2029. 60% was for the SPY, and TLT it was 40. And it you can see it is being followed. It is being followed, which we really want it to be the way. And if we go to this, yes, now okay, this is the uh, same one that I told you. We go to this one. This is a very important and a really interesting, bar graph that we're gonna discuss in today's video. And I would actually like to conclude that what we have learned. So over here, you could see that despite we didn't rebalance one portfolio, it has given us higher returns. But the with rebalancing one, it has not given you the higher returns. And this is something I'm telling you again and again, that in portfolio allocation, we don't care of the return. This is a secondary thing. We try to diversify our portfolio. We try to minimize our risk. So it is used for risk management in general. And over here, we could see that if any one of you, even me, have invested or had money in 2020 when the COVID or the pandemic hit. So it could lead to, so everyone would be in this case, and your allocation over here could be 60 to 40, but over here the allocation would be different. It is about like 82 or 18%, as we talked into this graph Excel sheet that I told you. Over here we could see it is 80 to 80% which is being followed. So we are not following the rules or the principles that we intended it to be. And despite getting the returns, we are trying to expose ourselves to the risk and everything. So in generally, uh, we it is something that people always forget, because they get good returns and they are like, okay, I really got good returns, and why does it even I care to try to rebalance the portfolio. But they don't forget, if the risk gets high, and the risk is very high, and in any case in the future your stock got completely destroyed, or you get fall very brutally, in that case your whole portfolio in general would be in the negative or would fall, since that one asset allocation is since your asset allocation for one stock is really much greater than any other stock. And this is something that we as people need to see. Over here as well, in the 2020, we if I try to zoom in, you may ask that, okay, then in this case, the rebalance should have done really good because it's a pandemic season. So if it is not working here, how it is, trying to how we are able to justify it. But the reason is, during the pandemic, your it is correlated. The bonds and stocks in general, it is correlated. And during this time, this equity market also fall down, as well as the bond market. So in generally, both are correlated, both fell down together. And this is the reason we saw a really sharp fall in March 2020 period. And you know uh, and before I try to, and I've told you a lot about this. Over here we could even see the without the annualized return, so it's about 11%, and with rebalancing is 19%. But the difference is in the annualized volatility. So the annualized volatility is about 13.61%, and for the rebalancing it's not very low, but it is something lower than the rebalancing. And the max drawdown is about minus 26 and minus 27.19. And if I try to talk more about what is we did over here, how we were actually able to, so we used NumPy, we used pandas and y finance for this. We fetch the data using the y finance, especially the historical data from the Dow 30. And we now calculated the monthly returns, the standard deviation, the volatility, and the sharp lightweight returns or the volatility in general. And in this way, it's not. And one thing, the tips I would like to give you is that this is not just an equal rebalancing. It is, an intelligent way you try to reallocate your funds. And portfolio rebalancing helps you to assign your capital with a better risk management, and gives you a risk adjusted return opportunity. It is something which is useful for passive investors wanting some quantitative edge in the future. And open source plus beginners and friendly learning, this is something that you could actually make and implement in your investing journey as well. And it can also be improved further by using machine learning or factor models if you try to use it. So this is the end of the video. I hope everyone liked it. Please subscribe and even tell me about any other you know idea or the topic I need to cover. For then, thank you.